So we continue with economics A level, government intervention. We've talked about minimum wages, we've talked about maximum wages. Today we want to talk about direct taxes, which can be used as government intervention in the labor market. So when we talk about direct taxes, we're talking about taxes charged on income or taxes paid to the tax authority. So that means you're paying it to those who charged it, who levied it on you. So those are who you have to pay to. So here I wrote, a direct tax is paid on by an individual or firm to the tax authority. The tax authority are those who levied that tax on you. So direct tax include income taxes, property taxes, and taxes on assets. Direct taxes such as income tax and corporate tax are a form of government intervention in the labor market that influences labor supply and demand by changing disposable income and investment incentives. With direct taxes, two things will happen because direct taxes are charged on income and profit. So which simply means it have income, it affects disposable income. Profit, it affects the corporation tax. It affects the profit. So corporation tax affects the profit of firms. Income tax affects the take home of employees. So that means a rise or a change in direct taxes will affect both the demand and supply of labor. Do you understand? So how direct taxes intervene in labor market? So we're going to start with labor supply. And when we talk about labor supply, we're simply talking about the willingness and ability of employees to make themselves available for job. That is labor supply. So taxes on labor income directly affect individuals' take-home pay. So whatever they get in terms of tax, or whatever the tax they have to pay, will affect what they take home. And that is what we call the disposable income. Because disposable income is that income that you can either spend or save, right? So what are the impact, what are the effects of labor supply on direct taxes? Number one, reduced incentives. So when we talk about reduced incentives, we're talking about a higher tax rate. So with higher tax rate, it reduces the financial incentive of workers because it means there's no reason to work. So when you do work, when you work long hours, you pay more tax. So there's no point. So it reduces your financial reward of working. So here I wrote, higher tax rate can reduce the financial incentive to work, potentially leading to reduced working hours in the legal market and more time spent in the household sector or the underground economy, which is the informal market. So with an increase in income tax, it gives you the disincentive to want to work. And even if you want to work, you won't want to work in the legal market because what in the legal market, there are regulations. So whatever you get, whatever your pay is, you have to pay taxes on it. So that encourages you to start thinking about bypassing government regulations. And to bypass the government regulation, you have to work in an informal economy. Do you understand the first point there? The second one, increased participation. Conversely, lowering taxes can increase disposable income, encouraging greater participation in the labor force. On the other hand, if income tax is cut, it gives you the incentive to want to work, and that increases labor participation rate. I think it's clear. A high tax reduces it, and a cut in tax increases the participation of labor force. Any question about labor supply? Now go to labor demand. And when we talk about labor demand, we're talking about numbers of workers firms are willing and able to employ at a given wage rate, right? Good. So what is the effect of direct tax on labor demand for labor or labor demand? Direct taxes such as corporation taxes can influence a firm's decision to hire. So for firms, they only hire it. So whatever, if firms have to employ workers, they only employ workers if the terms and conditions are right, especially when it comes to taxes paid, because taxes is part of their cost of production. So the first one is investment incentives. Lower corporate tax rates can stimulate investment, leading to increased competitiveness and greater job creation. If the tax rate is low, firms have the incentive to want to employ more workers, and they can also, invest more. And that will create what? Job opportunity for potential employees. Competitiveness. High tax burdens on businesses can make them less competitive, potentially reducing employment. So if taxes on profits are high for firms, it means their return on investment reduces. Because their return on investment reduces, they won't be competitive. And that reduces employment opportunity because they won't be able to create more jobs. A firm that is not competitive, what's the essence of increasing job opportunity or expanding? They won't be able to expand. And if they cannot expand, they cannot employ more workers. So that is the effect of direct tax on labor demand and labor supply. Any question about that? Okay. And the third one, income distribution. And when we talk about income distribution, we're simply talking about trying to reduce the gap between the rich and the poor. So for income distribution, mostly when we talk about income distribution, we think about progressive tax. Progressive tax is charged on high income earners, right? Okay. So for progressive tax system where higher earners pay a large proportion of their income in taxes can moderate wage and reduce unemployment in non-competitive labor markets by easing pressure for high wage claims. What does that simply mean? It means when there's progressive taxation, especially in a non-competitive labor market. So it simply means you as a high income earner, you won't have any incentive or you will be discouraged to claim higher wages because when you claim higher wages, you have to pay more taxes. So more progressive tax reduces the incentive for workers to want to earn or to want to request for higher pay. Do you get the point I'm making? So because workers stop requesting for higher pay, it encourages firms to start expanding and increase employment opportunity. Do you understand what progressive tax is? So progressive tax mostly is not just about making encouraging high or making high income earners to pay more. It also increases the employment opportunity because when you are discouraged to ask for more pay, it means firms will have more in terms of their returns. So because they keep this profit, they might be able to expand. They might be able to expand. Do you understand?
Yeah.
So that's why I said employees will be discouraged to request for higher wages. And that is a bonus or for firms. Do you get it? Do you get it, please?
Yeah.
And the last one, reducing inequality. Tax and transfer system as a whole can temper increasing inequality in market incomes, leading to a more stable and equitable distribution of disposable income. So for income distribution, which is also part of direct taxes, it brings about progressive taxation and reducing inequality. And when we talk about reducing inequality, because tax, because tax and transfers are ways in which you can find a way to reduce or to make sure that wage rate is stable within the economy. So if wage rate is stable within the economy, it means disposable income would increase. So employees are certain that whatever the tax system is, it is beneficial to them, and their take-home pay will be able to increase. So these are the effects of taxes, or direct taxes on demand for and supply of labor. It has impact on income distribution, it has impact on labor supply, and it has impact on labor demand. Any question about that? Good. So that takes us to the impact of direct taxes in the labor market itself. Be right back. So go to the impacts of direct taxes in the labor market. When we talk about the labor market, we're simply talking about where the demand for and the supply of labor intersect or have relationship. So what are the impact of direct taxes on labor supply? For workers, income taxes create a disincentive to work by reducing the net after tax wage. Economic theory presents two opposing effects on individual decisions to work. So we have two theories about an individual wanting to work. The first one is substitution effect and the income effect. So how does substitution effect and income effect takes part or affect labor supply when it comes to direct taxes? So we're going to start with substitution effect. An increase in income tax reduces the reward for working. As a result, it becomes cheaper to have leisure time. This encourages workers to substitute away from work and have more time for leisure. An increase in income tax means your take-home pay reduces, yes or no? So if your take-home reduces, then that gives you the disincentive to want to work. So leisure becomes a substitute for working. So based on the fact that your take-home pay when you work reduces, then it means leisure time becomes cheaper. As leisure time becomes cheaper, it means you can go for leisure instead of working so much hours at workplace. Do you understand substitution effect here? That is substitution. So you are substituting work for leisure based on the fact that income tax has increased. Do you get it?
Yeah.
Then the income effect. A higher tax rate means less disposable income. To maintain their standard of living, some individuals may feel the need to work more hours to compensate for the lower take-home pay. So the income effect. Because your income tax has increased, so this means you have to start thinking about how to cover up for the low take-home pay so that you can maintain your standard of living. So that means workers will start thinking about working more hours to maintain their standard of living. So that's the impact on labor supply. When we talk about the impact of labor supply, we're talking about workers that are making themselves available for job. An increase in income tax bring about substitution effect and income effect. For substitution effect, it simply means because of an increase in income tax, workers will start thinking about leisure as a substitute for working because leisure becomes cheaper. And income effect simply means disposable income is falling based on the fact that income tax has increased. So workers will start thinking about working more hours to cover up for the low take-home pay. I think it's clear. For them to be able to maintain their standard of living. Any question about the impact on labor supply when it comes to direct taxes? No, good. So the impact of direct tax on labor demand. When we talk about labor demand, we're simply talking about employers willing and able to, employ workers at a given wage rate. So what are the impacts on labor demand when there's direct tax? For employers, direct taxes on labor, such as payroll taxes like social security contributions, increase the cost of hiring and employing workers. Because as soon as employers employ a worker, they have to start preparing for their pension. So that means they have to start contributing part of what they give. So they pay employees and also they contribute towards their pension. So that increases the cost for firms, yes or no? So the impact now, increased costs. Higher employers paid payroll taxes push up the total cost of labor, which can decrease the quantity of labor demanded for firms at any given wage rate or wage level. Because firms have to pay higher wages, higher taxes or contribution for employees. So it simply means their cost of production would increase based on the fact that they have to pay higher wages to their employees, and that increases their cost of production. So the only way to reduce their cost of production is not to employ workers. So the demand for labor would reduce as a result of direct taxes. The first one clear? Yeah. So reduced hiring. A reduced demand for labor can lead to fewer jobs vacancies and slower employment growth. Some firms may also choose to substitute labor with capital, particularly in the long run. So when you look at the last note here in the textbook, the last note, they said it reduces employment, higher capital. You saw it there. So the point they're making is this. Based on the fact that employing workers become an increasing cost based on the fact that they have to pay taxes. You won't pay tax on equipment. You won't pay tax on machinery. Yes or no? So you start reducing the demand for workers to start investing in capital. And when firms start using capital, because capital is a substitute to labor, so it means they don't have any reason to employ more workers. That reduced hiring. Is it clear? Yeah. Especially in the long run, though. In the short run, some factors are, in the short run, some factors are fixed. You get it, right? Yeah. So that's the impact on labor demand when it comes to direct taxes. Any question about that? No. Good. So that takes us to the impact on the market equilibrium, where we have demand for and supply of labor intersecting, right? Good. So the last note on direct tax is the impact of direct tax on the labor market equilibrium. There's equilibrium where the demand for and supply of labor intersect. That is equilibrium. So here I wrote, direct taxes influence the labor market equilibrium of wages and employment. Wages, employment, though they have to be intersection, right? So through the following reasons. One, creating a tax wedge. When we talk about tax wedge, we're talking about the gap between what employers pay to their employees and what they have to pay in terms of taxes or contribution. So firms or employers, they have to pay certain contribution and also they have to pay employees. So the gap between what they pay them is called the tax wedge. Do you get tax wedge here? Yeah. Okay. So I wrote creating a tax wedge. The sum of the personal tax and social security contributions to tax wedge. In essence, it creates a gap between what employer pays, and the wage workers receives. So the size of this wedge directly impacts in the market efficiency. So when I talk about equilibrium, so what firms are paying, what firms are willing to pay, and what they actually paid, and what workers are willing to get or willing to accept, and what they actually accept affects the efficiency in the labor market. And these things are based on the fact that there's direct taxes. Direct taxes shifts the situation. It changes the whole scenario. So they might not be equilibrium. Do you understand? Good. So shifting the burden. So how do you shift the burden when it comes to direct taxes? So remember, to shift the burden on tax is based on the elasticity of demand for and supply of labor. So if the demand for labor is highly inelastic, it means firms don't have any other choice than to pay higher wages, and that increases the cost of production for them. Do you get the point here? So that means the burden on tax is shifted to the firms because the demand for labor is highly inelastic. On the other hand, if the supply of labor is highly inelastic, it means workers will have to bear the burden on taxes. Do you get it?
Yeah.
So here I wrote, the extent to which the tax burden is shifted from employers to employees depends on the elasticity of demand and supply. If labor supply is more inelastic, workers will bear more of the burden through lower net wages. So their wages are expected to fall based on the fact that they bear the tax burden because supply of labor is more or highly inelastic. So irrespective of whatever the wage rate is, they need work. They need to work. They need to make themselves available for job. So it means they bear the burden. Why would they bear the burden? They bear the burden because at that point in time, employers are the price maker. Do you get it?
Yeah.
Okay, so that's shifting the burden to employees. The burden will be shifted to employees if the supply of labor is more or highly inelastic. Now, on employers, right? Okay, if labor demand is more inelastic, firms will bear the burden through higher labor cost. So for employers, if the demand for labor is highly inelastic, which simply means irrespective of what the wage rate is, firms have to employ more workers. So they have to attract them with wage pay. So it means they have to bear the burden through high labor cost. Employees bear the burden through low net wage. Employers bear the burden through high labor cost. I think it's clear.
Yeah.
Any question about that?
No.
And the last one is discouraging formal employment. So that's the last impact. So when we talk about formal employment with high tax rate, firms, employees, it affects both employers and employees. So based on the fact that income tax is increasing, corporation tax is increasing, this gives firms and employees the reason to start thinking about the informal economy. They have to bypass regulation. They have to evade tax. So here I wrote, in some countries, especially those with high labor informality, high direct taxes are a major factor driving employees and employers into the informal economy, where taxes and regulations are evaded. So they try to bypass regulation, they try to bypass taxes because high taxes affect both firms and employees. Like what we talked about earlier, if the demand for labor is highly inelastic, it means high labor cost. So firms will start thinking about bypassing regulations, going through the informal economy. And if for firms, if for employees, they have to pay high income tax, based on the fact that the supply of labor is highly inelastic, they also try to, go through through the informal economy to get jobs. So both employees and employers will have to start thinking about bypassing regulations and evading tax if tax continue to rise over time. So that ends direct taxes and its impact. So this is the impact of impact on the equilibrium labor market. I think it's clear. Any question about it?
No.
Good. So in the next class, we'll round up the measures to reduce discrimination and geographical mobility. And that ends chapter 20. Any question?
No.